Historically, the concept of Islamic finance can be traced back to the time of Prophet Muhammad sallallahu alaihi wasallam, who engaged in a mudarabah contract with his wife Khadijah radhiyallahu anha. Mudarabah is a partnership contract in which profits and losses are shared between the parties involved. According to previous literature, the modern practice of Islamic banking and finance began in the mid-1940s in India and Pakistan. In addition, the Milk Gomar Savings Bank in Egypt was established in 1963 as an interest-free bank that generated profits through business activities. The bank was founded by Ahmad al-Naggar and operated based on Islamic Sharia principle. Sharia governance is a system that protects Islamic banks from Sharia non-compliance risks by using internal checks and external checks. The system is crucial because it builds customer trust and ensures everyone knows the products are truly halal.
This case illustrates a Sharia governance failure in Islamic bank, whereby a new investment product was launched without the consent and obtaining prior approval itself from the Sharia committee. As a result, the new investment product was later found to contain elements that were inconsistent with approved Sharia contracts. This kind of situation reflects weaknesses in governance and internal control, which contributed to this issue, especially in terms of its procedural compliance, Sharia risk management, and obtaining Sharia approval before launching the new product. Sharia contract models are Islamic-based contracts used to regulate financial and commercial transactions in accordance with Sharia principles. They promote fairness, transparency, and the sharing of risk between the parties involved. Under Section 28 Clause 1 of the Islamic Financial Service Act 2013, Islamic financial institutions must ensure that all their operation and business activities comply with Sharia at all times. In addition, IFSB 21 requires a financial transaction to avoid prohibited elements such as riba, gharar, maisir, and investment in non-halal business like liquor, pork, and conventional insurance.
This part is about the analysis of the case studies issue. It contains two main subtopics. The first one is the analysis of the weaknesses in governance and internal controls in the Islamic bank operations, while the second one is the analysis of the responsibilities of the governance bodies, which are the board of directors, management, and Sharia committee in handling the Sharia non-compliant risk event. So what is the Sharia non-compliant risk? It is risk linked to the failure or inability of Islamic financial institution to adhere to Sharia regulations and principles. Now we will discuss about the first part of the analysis. Based on the case studies issue, it could be understood that the product contains elements which inconsistent with approved Sharia contracts, which the product launched without prior endorsement from Sharia committee. This issue arises from the lack of communication between the three governance bodies and the failure of the governance bodies to fulfill their responsibilities as outlined in the Sharia governance policy document issued by the Bank Negara Malaysia in 2019, as well as standards developed by Islamic Financial Services Board, IFSB. The senior managements who are not accountable to implement the Sharia governance policies also contribute to this issue. By virtue of paragraph 35 of the Islamic Financial Services Board 31, it is provided that supervisors should determine that IFI or IIFS, Islamic Financial Institution, have implemented the essential elements of Sharia governance. Based on this principle, the Bank Negara Malaysia, who are the responsible supervisor, has issued the Sharia Governance Policy Document 2019 uh, and outlined the key responsibilities of the governance bodies. Now, we will discuss about the second part of the analysis. According to paragraph 8.1 of the SGPD 2019 by the Bank Negara Malaysia, it highlights the key responsibilities of the Board of Directors, BOD. The BOD must approve policies and governance frameworks related to Sharia governance and Sharia non-compliant risk management. The BOD also must oversee the implementation of Sharia Advisory Council rulings and Sharia committee decisions across all business of the Islamic bank operation, and the BOD must ensure effective internal controls and corrective measures to prevent the Sharia NCR event. The BOD also must have a good communication with Sharia committee, where it is stated in the paragraph 9.1 of the mentioned policy document, where the BOD is required to give proper decisions and advice provided by the Sharia committee on matters related to the Islamic financial institutions' business affairs. This includes the BOD to consider implications of implementing Sharia Committee's advice. By virtue of paragraph 10.2 of the SGPD 2019, the Sharia Committee is responsible for ensuring that the Islamic financial institutions' activities are compliant with Sharia principles, advising on the application of the Sharia Advisory Council rulings, addressing potential Sharia and CR issues, while endorsing appropriate rectification measures for any identified non-compliance events. In addition, in paragraph 15.1 of the same policy document stated that the CEO who lead the senior management of the Islamic financial institution must ensure the Sharia compliance in all operations of the institution, establishing clear accountability for managing Sharia and CR, implementing Sharia governance policies directed by the board, while applying SSC rulings and Sharia committee advice. As the proposed solutions of the case studies issue, there are two main solutions. The first one is the establishment of clear accountability lines for senior management in implementing Sharia governance policies. This means that the management or the senior management's officers in the Islamic Bank must be accountable to practice the Sharia governance policies in a systematic way, while the strengthening the integration of Sharia governance bodies means there is a strong communication and interaction between the Sharia committee, boards of directors, and the senior management in order to handling the operation in the Islamic Bank activities in a systematic way to avoid the occurrence of the Sharia non-compliant risk.
So now I will explain about the operational structure of Wakalah model in family Takaful. Basically, Wakalah is based on agency concept where the participants are the owner of the fund, while the Takaful operator acts only as a manager or agent. In the system, participants contribute regularly and part of the contribution is deducted as a Wakalah fee to cover management costs. The remaining amount is then split into two main funds. The first is the participant investment fund, which is used for saving and investment purpose. The second is the participant risk fund, which provide protection and handle claims. This whole structure is based on the principle of tabarruk and ta'awun, which means donation and mutual assistance among participants. Moving on to investment of fund, both PIF and PRF are invested in Sharia compliant investment, and any return generated are credited back to the participant instead of the operator. For claims, payments are made from the PRF when events like death or disability occur. If the fund is not sufficient, the operator will provide qardu, which is an interest-free loan, to cover the deficit. Finally, the surplus distribution. If there is any surplus in the PRF after covering claims and reserve, it will be returned back to the participant since it is belong to them and not the company. Now, I will explain about the Sharia issue of excessive wakalah fee. The first issue is justice. Islam emphasizes fairness in every financial transaction. So, when the operator charges a very high wakalah fee, less money go into the participant risk and investment funds, which means participants receive fewer benefits even though they have contributed the same amount. The second issue is fiduciary responsibility. Since the operator acts as an agent, it has the responsibility to manage the participant funds honestly and in their best interest. So, if the operator focuses more on increasing its own profit than protecting the participants, they have failed to fulfill that responsibility. The next issue is public interest and participant welfare. A high wakalah fee can reduce the amount available in the participant risk fund. As a result, the fund may become less sustainable in the future, and participants may also receive lower surplus distribution. Over time, this will reduce public confidence in the Takaful system. Finally, high wakalah fee also affect the maqasid Sharia, especially the objective of Nuzulman. In other words, instead of protecting and growing the participant wealth, excessive fees reduce their financial benefits and weaken the real purpose of family Takaful, which is based on mutual protection and shared responsibility. Next is the governance issue. The first issue is that the operator prioritizes profit over participant interest. In other words, the focus shifts from protecting the participant into maximize the company's profit. This is again the Islamic Financial Service Act, which is clearly stated that participant interest must always come first whenever there is a conflict. Another issue is weak board oversight and independence. The board of directors is responsible for monitoring the management and ensure that all decisions are fair and in line with good governance. So, if the board allow an unfair fee structure without taking any action, it shows that its oversight is not effective. The next issue is ineffective of Sharia committee. Since every Takaful operation must comply with Sharia principle, the committee should review and advise the board if the fee structure becomes unfair. If no action is taken, it will reflect weak supervision of Sharia governance. Another issue is poor fund management. Excessive wakalah fee can reduce the amount available in the participant risk fund. This will limit investment opportunities and may affect the long-term financial stability of the Takaful fund. Finally, lack of accountability and transparency. Transparency is important to ensure good governance. The Takaful operator must clearly disclose how the wakalah fee is determined. If this information is not communicated properly, participants may find it difficult to make informed decisions, which can affect accountability and public confidence.
Bank Negara Malaysia guidelines requires wakalah fees to be clearly defined and agreed at the beginning of the contract. These fees may be fixed, percentages based, or linked to performance, but they must always be transparent and justified. This is to ensure clarity and avoid any ambiguity in remuneration. In terms of fairness, B&M emphasized that participants' interests must be protected at all times. The participants' risk fund must be managed to ensure long-term sustainability, and surplus distribution must follow actuarial principles so that no group is unfairly treated. This shows that fairness in Takaful includes both proper process and fair outcomes. B&M also requires strong disclosure practices. Takaful operators must clearly explain wakalah arrangements, including fee structures and payment methods. This ensures participants fully understand their contract and help build trust in the system. Moving to the Islamic Financial Services Board (IFSB) standards, they strengthen Sharia governance by focusing on ethics, accountability, and role clarity. In wakalah-based takaful, participants own the funds, while operators act only as managers. This reflects the principles of tabarruk and mutual cooperation and ensures the system remains Sharia compliant. The IFSB also emphasized participant protection through continuous disclosure. Participants must receive clear information about fees, risks, and fund performance, especially in long-term family takaful contracts. This allows them to make informed decisions throughout the contract period. Finally, several improvements can strengthen wakalah-based takaful. Fee structures should be more transparent and standardized. Surplus distribution must be fair and supported by strong actuarial control. In addition, Sharia governance and internal oversight should be strengthened to ensure full compliance and improve public confidence.